is needed. Okay. Consolidation is needed in that case. So what I'm going to do is actually show you an example of what that would look like. Okay. In your lesson notes, so it's example 6.7, example 6.7 that I'm going to do. Now, this will take us a while, and I want us to make sure that we read the question and so on. It's also 7:20, okay? So what I'm proposing is we take a short break, and then we'll come back and I'll walk you through this piece here. And I'm going to be introducing quite a few little details. We're going to introduce you to the concept of non-controlling interest, and I'm going to show you how to make a consolidated balance sheet on the date of acquisition, right? So when you have NCI, you will actually be dabbling with Chapter 4 stuff as well. So I want you to clear your minds of any kind of, if there's any kind of cloud, etc., go pull a breath of fresh air, etc. If you are a little bit tired, maybe get a glass of wine or whatever. And in about 10 minutes time at 7:30, we'll get back and talk about this. Does that sound like a plan? Okay. So talk to you guys soon. I'm just going to pause the recording. So control, actual control. See, purchase of net assets results in the acquirer getting physical control over the acquiree's assets and liabilities. Now, control does not have to result in physical control. So there's a question from Firoz. What's the benefit of this combination to Beaver in example 6.1? Well, Beaver, if you look at the scenario, Beaver is looking at a whole bunch of accumulated losses. So they're essentially not doing that well, right? So they figured the directors of Beaver Inc. would have felt, well, we're not doing that well. Might as well sell this business to some other company, and we are okay with. So Beaver is actually, so they no longer have to worry about their liabilities. They've got a little bit of cash on their hand, and they've got this investment in Moose, right? So assuming Moose does a better job of running the business, Beaver will benefit from the appreciation, the capital appreciation. But as such, it would have been a business decision. We're not doing well. we've got a ton of these liabilities. We just want out. So Beaver's management basically sold out. Okay. Now, as I was mentioning, without getting physical control, right? So without physically taking over the assets and liabilities of the acquiree, control can be obtained in two ways. Either by purchasing the majority of voting shares, and that's the purchase of shares method, or by a contractual arrangement. We'll talk about that as well as a part of this topic. So this first part, the purchasing of the majority of voting shares, is basically what I was alluding to here. The parent company can buy a majority. So to get a majority, all you need is more than 50% of the voting shares. So when you have this purchase of shares, and what this implies is you don't have to actually buy 100% of the shares. You can buy less than 100% and still be in control. Right? So if the parent company has control over the subsidiary, the other shareholders of the subsidiary are called non-controlling interest. NCI. So in example 6.7, that's what we are going to be seeing here. The setup is very similar to what we saw for 6.1. It'll seem like almost it's the same problem. So I just changed the names. Papa Inc. and John Inc. Okay, had these balance sheets before the acquisition. Papa had 200,000 shares outstanding. John had 100,000 shares outstanding. Market price of Papa shares, $5. Price of John's shares, $6. John has an unrecorded patent, $50,000. After close of business on December 31st, 2004, Papa Inc. bought 75% of the common shares of John by paying $150,000 in cash and issuing 90,000 of its own shares. John Inc. also paid $30,000 in legal fees to complete the transaction and $25,000 for stock issuance costs. So the setup is fairly identical, almost the same as what we saw for Moose and Beaver, with one difference, that whereas in the case of Moose and Beaver, Moose had bought the net assets of Beaver. In this instance, Papa is buying 75% of the common shares. Now, buying 75% of the common shares makes Papa Inc. the majority shareholder of John. And being the majority common shareholder of John, Papa Inc. has control over John. Okay? So Papa Inc. is the acquirer. So John had to pay $30,000 in legal fees to complete the transaction and $25,000 for stock issuance costs to buy the 75% of the common shares. They're not the acquiree. Acquirer is the company that buys. Acquiree is the company that is purchased. Oh, oh, Harjinder is okay. You found a typo for Harjinder. Oh my goodness. Ah ha ha. Papa paid. Oh, hey, thanks for pointing that out. Jeez, I'm getting rusty here. Thank you, I appreciate that. This better? Papa paid 30,000. Okay, yeah. That would have totally changed a whole lot of meaning there. Okay, so you notice here in the requirement, they're asking for a consolidated balance sheet. And they mentioned under the fair value enterprise method, identifiable net assets method. Now, these two methods, the fair value enterprise method, we call that the FVE method, and the identifiable net assets method, or the INA method, are basically two ways of measuring or valuing non-controlling interest. These are two methods for valuing non-controlling interests. So I explained this part in the lesson notes, if you and the video. So if you watch the video, you'll probably remember that part. Arsh, yes. So that was a typo in the lesson notes. That's what Hugo. That's why Hugo asked me. It says John Inc. paid. That was a typo. So it should be Papa paid. Okay. I'll fix that. Hopefully, I'll get around to fixing all of those typos and posting the lesson notes back again. All right, so I'll get to these differences in a bit. I just want us to first get acquainted with the steps to prepare the consolidated balance sheet. On the date of acquisition. So step one is about identify the acquirer and the acquisition cost. Step two, you calculate the acquisition differential and goodwill. Step three, you calculate non-controlling interest Well, I mean, I think in my lesson notes and the video, I think I used A, B, C, that kind of thing. But never mind. Just basically, you got to calculate non-controlling interest, the amount for non-controlling interest, and then step four, you prepare the consolidated balance sheet, statement of financial position. So over here, identifying the acquirer and the acquisition cost. Here, it's fairly straightforward because it's clearly Papa is issuing or is paying $150,000 of cash and is issuing 90,000 of its own shares. Papa already had 200,000 shares outstanding. So even after issuing an additional 90,000 shares, the existing shareholders of Papa will have a majority stake in Papa Inc. So this wouldn't be a reverse takeover. For those that watched the video, I talked about reverse acquisitions. Reverse acquisitions would have happened if, in making this business combination, Papa Inc. had ended up issuing more shares than the existing outstanding number. So Papa had 200,000 shares outstanding to buy John. If Papa ended up issuing, say, 250,000 shares, then that could end up being a reverse acquisition. Okay. Hostile takeover is doesn't necessarily have to be a reverse takeover. The reverse takeover is where legally, so Papa is acquiring John Inc., right? So legally, Papa is the acquirer. But the way the deal is set up in a reverse acquisition is where John Inc. ends up being in control. Okay. A hostile takeover, on the other hand, well, recently Obsidian Energy made a bid for Bonterra Energy. Um, it's where a company buys a certain number of shares on the market. So, you need to get about 10% or thereabouts. And then you make this announcement, we are interested in taking over and we are willing to pay this price. All right. And so it was an unsolicited, right? If it's an unsolicited bid, then that's the situation where it's an unfriendly, right? Hostile is another word for unfriendly. Now, if the two companies have been having talks, then that's a different matter. And there have been a fair number of mergers and acquisitions taking place um, in this world of COVID. But that Obsidian Energy, Bonterra Energy was sort of a place where Obsidian was making an unsolicited offer for Bonterra, wanted to buy Bonterra Energy's common shares from its existing common shareholders, and the board at Bonterra Energy said it's not a good deal. Uh, we do not support it. So if Obsidian ends up still taking over Bonterra, that would be a hostile takeover. Okay, so I'm going to go through each of these steps here for you guys. So step one, identifying the acquirer. Papa Inc. is the acquirer. The acquisition cost of 75% of John Inc. Now, acquisition cost includes any cash paid. So Papa is paying cash 150,000 and plus fair values so fair value of any other consideration. So fair value of shares issued. So how many shares is Papa issuing? They're issuing 90,000 common shares. And the market price of Papa shares on December 31st, 2004, or 2000x4 was $5. So 90,000 times $5, that's $450,000. And there's nothing else that Papa is promising. So the total acquisition cost works out to $600,000. So step one says identify who the acquirer is. These are requirements of IFRS 3 consolidation. You need to identify who the acquirer is and what is the acquisition cost. Step two, you will take this information to calculate the acquisition differential and goodwill. So step two, calculation of acquisition differential and goodwill. So here, I'm going to first show you how the calculation would work under the fair value enterprise method. Okay. So cost of 75% of John Inc. as per our calculation is $600,000. All right. Now, 75% of John is $600,000. What does that imply to be 100% of John? If 75% of John Inc. is worth 600,000, what does that imply for 100%? So Hugo did the math. Hugo said if 600,000 is 75%, then 100% would be 600,000 divided by 75%, you get $800,000. Right? Alternatively, what we could have done is we could have calculated non-controlling interest. So if 600,000 is the value of 75%, if 75% of the shares are owned by John, by Papa, NCI owns 25%. What is 25% worth? If 75% is worth 600,000, 25% NCI will have been worth 200,000 exactly. So if 600,000 is worth is 75%, then 25% is 200,000. And the total value of John is fair value of what the parent company paid, $600,000, plus fair value of non-controlling interest, which is 200,000. Added together, we get a total value for John Inc., $800,000. So this transaction, this purchase of 75% of the shares of John Inc. by Papa has valued John Inc. at $800,000. Out of the $800,000, 600,000 is owned by Papa, the parent, and 200,000 is owned by non-controlling interest. Okay. Now, this implied value, so the value of the subsidiary is made up of three things. The net book value, which is basically nothing but shareholders' equity. Fair value differences. And goodwill. You've seen this movie somewhere, right? You've seen this happen somewhere earlier. Net book value, fair value differences, goodwill. You've seen me talk about these, or you've heard me talk about these things when we were covering topics 4 and 5. We were talking about investments in associates and the investments in joint ventures. You heard me talk about them. In consolidation, you'll be dealing with them pretty much on a daily basis. Okay, so this $800,000 valuation that we're seeing for John Inc. consists of net book value of John. So net book value of John Inc. What is that made up of? So John Inc. has common shares, 100,000, retained earnings, 200,000. Now preferred shares. For control, the acquirer, the parent, needs to buy voting shares. Preferred shares don't have voting rights, right? So preferred shares, if the subsidiary has preferred shares, these preferred shares, you got to ask yourself, does the parent own them? If the parent company owns them, just eliminate as intercompany investment. If owned by other shareholders than the parent, then the preferred shares of the subsidiary are included in NCI, non-controlling interest. Okay, so in example 6.7, our friend John Inc. has $100,000 worth of preferred shares. These preferred shares, there's no indication that these preferred shares are owned by Papa, right? Papa doesn't own any of the preferred shares issued by John. So these preferred shares will be actually included in non-controlling interest. So I need to make a little bit of a change here. This amount that we calculated for NCI is just the NCI, non-controlling interest, for the common share, the common shares. There is a preferred share portion that is separate. The other thing that you have to, again, if you folks watch that video, this will all be kind of making sense because I talked about every darn little piece here. Any pre-existing goodwill, any existing goodwill for the subsidiary is deducted or subtracted from the net book value when calculating acquisition differential. So here in 6.7, we're looking at common shares, $100,000, retained earnings, 200,000, right? So for John, common shares, 100,000, retained earnings, 200,000. So net book value of John, common shares, 100,000, retained earnings, 200,000. 100 plus 200, you get 300,000. But from this amount, you need to subtract the existing goodwill on the books of John. So if there's any existing goodwill, so John has $75,000 of goodwill sitting on its books. That existing goodwill is subtracted from basically the retained earnings. For our purposes, it's the net book value. So net book value of John, 100,000 plus 200,000 minus 75,000. So 225,000. So it's common shares plus retained earnings minus any existing goodwill on the books of the subsidiary. All right. So this is quite intense. I'm hoping you guys are making notes, you're taking down notes, writing stuff down. The easiest way to do that is if you just kind of click here, you can insert a comment, right? So if you right click on the cell, insert a comment, you can kind of write reminders to your own self. What is that? Why did I do this? Okay, so $800,000 value of John is made up of net book value 225,000. So out of the 800,000, if I take away $225,000, I'm left with the acquisition differential $575,000. This $575,000 is allocated to fair value differences. And here, remember, for the fair value differences, recall for these fair value differences, it was, you can have assets, liabilities. Assets could be understated or overstated. If the assets were understated, the fair value difference is a positive. If the assets are overstated, the fair value difference is a negative, right? So that thing that I talked to you folks about earlier in topics 3 and 4, this is pretty much going to be our daily bread and butter now. So allocated to the fair value differences. So we're talking about John. So if you look at John Inc.'s numbers, so do we have fair value differences? So let's calculate. Do we have fair value differences for cash? So fair value minus the book value. So we have nothing for the cash. The accounts receivable is overstated by 5,000. Inventory is understated by 20,000. Land is understated by 110,000. Property, plant, and equipment is understated by 65,000. And the liabilities are understated by 25,000. Okay, so we have fair value differences for 1, 2, 3, 4, 5. And remember that John has an unrecorded patent worth 50,000. That's a total of 6 items for fair value differences. There's an unrecorded patent for John, and these items had fair value differences. So when I'm allocating to fair value differences, I've got accounts receivable, I've got the inventory, up to property, plant, and equipment, then include the patent, that was the unrecorded patent, and then for liabilities, there is a fair value difference. Now, accounts receivable is understated. The $5,000 difference is a positive. Inventory is overstated. The difference is a negative. Patent had a fair value of $50,000. It's unrecorded. So $50,000 entirely is the fair value difference. And for liabilities, just remember liabilities, with liabilities, it goes the other way. When you have an understated liability, the difference is a negative. So this 25,000 will be included as a negative. Okay, accounts receivable, once again, book value was 175, fair value was 180. So accounts receivable for John is understated by 5,000. Understated assets is a positive. So for my fair value difference, I wrote 5,000 positive. Inventory, book value is 200,000, fair value is 180,000. Inventory is overstated by $20,000. Overstated asset is a negative, so this $20,000 I'm going to put as a negative, and so on. Is that good? This piece, folks, you just need to absolutely own it, because there's a lot. There's a lot that's coming down our way. All right. So this whole thing about allocating to fair value differences, calculating goodwill, and so on, you will need to embrace it like a duck takes to water. I want to hear from people. I don't want you to be courteous and respectful. So Hugo, Papa is not bought. So here's something that you got to understand. Papa is getting control over John, warts and all, right? You know, it's like everything. So if John Inc. has that patent, the whether it's not recorded on the books or not, if that patent has value, that value was negotiated as part of the deal, and Papa will allocate the fair value difference. It just is not possible. You cannot pick and choose. So John has a patent. It's not recorded on its books. The patent has value. Not recorded means book value is 0. Fair value of the patent is 50,000. That fair value difference has to be included. Papa cannot say, oh, I didn't buy the patent. They bought John. Everything included. It's like I mean, I don't want to sound like I don't want to go down that path, but it's like, a second marriage, comes with kids, it comes with kids, right? You can't say I'm going to marry you, but I don't want your kids, right? So the kids come. Here, Raul's got the question, what's the net book value? So net book value is the common shareholders' equity. So common shareholders' equity is common shares plus the retained earnings. So 100 plus 200. If the company has any existing goodwill, and John did have existing goodwill, the existing goodwill is subtracted from the net book value. So 100 for common shares, 200 for the retained earnings, minus 75,000 for the goodwill. That's what got us the 225,000. Okie dokes. So we're good with that. The total of the fair value differences is 185,000. Out of our 575,000, 185,000 is allocated to fair value differences. What is left, 390,000, is goodwill on acquisition. No, Julia, it will be at 100%. So we use the acquisition method, the entire goodwill. So the way control works is control is absolute, right? So control is absolute. All right. So it either exists or it doesn't. All right. So if Papa has taken control over John, Papa may own. So although Papa will own 75% of John's common shares, Papa controls 100% of John. That's a very, very, very important thing to keep in mind. Significant influence was different because it was limited. Our influence was limited to our ownership. In the case of joint ventures, the whole point was shared control, right? A joint arrangement, the hallmark of a joint arrangement was shared control. In the case of, well, here, the parent sub, even though Papa owns 75%, it controls 100%. So goodwill, etc., everything's got to be at 100%. That was a very important question. I will not disparage the other people asking questions. They're all good questions, but this is an important question to ask. Okay, so I don't want to see you folks multiplying it down to 75 and so on. That part is gone. That train is left. Once we are in the consolidation world, 100%. Okay. Okay, so we got step 2 done. Step 3 is NCI, non-controlling interest. So NCI here has got 2 parts. There's the NCI common, which we calculated. It's 200,000. And then there's the non-controlling interest relating to the preferred shares. So in the information, the preferred shares have a value of $100,000. That $100,000 belongs to the preferred shareholders who are also part of NCI. So total non-controlling interest, therefore, is $300,000. All right. So step 1, step 2, step 3. Step 4 is you want to prepare the consolidated statement of financial position. Now, when you make the consolidated statement of financial position, what you want to do is add together the parents and the subsidiaries statement of financial position items, right? You're going to add them together line by line. And of course, you're going to make some adjustments. The adjustments will be, number 1, you will eliminate. What does the word eliminate mean, folks? You want to eliminate, remove, get rid of. Exactly. So what you're going to do is you're going to eliminate the investment in the subsidiary and the subsidiaries common shares, well, shareholders equity, basically entire shareholders equity and existing goodwill. All right, so you're going to get rid of the investment in the subsidiary account and the subsidiary's entire shareholders equity and existing goodwill. You'll get rid of those items. You will include a few things. You will include goodwill on acquisition that you calculated in step 2. You will include non-controlling interest that you calculated in step 3. And you will include fair value differences that you calculated in step 2. Okay, so in order to make the consolidated balance sheet, though, look, this balance sheet information was before the acquisition. I need, first of all, in order to make the consolidated balance sheet, I need to adjust this balance sheet information to after acquisition. So I have to, so this balance sheet, these balance sheet numbers that I have, they're actually not balance sheet information after the acquisition. I need the after the acquisition numbers. All right, so I gotta make that first. Now, when I make the consolidated balance sheet, of course, it needs a title and all that. The balance sheet will be prepared in the books of the parent company. So who's the parent? Papa. So it'll be in the books of Papa. You're going to call it the consolidated statement of financial position or consolidated balance sheet. And of course, its balance sheet is prepared at a certain date at December 31st, 2000-4. Now, we will only report the consolidated column, but in order to get there, because we have to do some work, I'm going to show the workings right here. Okay, so here I go. I'm going to copy the account names. So all these are the account names here. I am going to make a column for Papa Inc. and a column for John Inc., the parent and the subsidiary. And then I'm going to leave some columns for the adjustments. Now, there can be many adjustments. I typically make at least 3 columns, and then I'll have a consolidated column. All right, so first help me out. What happens? So Papa. Now, we didn't record a journal entry, etc. I think it may not be a bad idea to record a journal entry. So if you want to do that, what's the journal entry? Journal entries for the acquisition here. What did Papa do? After close of business on December 31st, 2004, Papa acquired 75% of the common shares of John. So Papa Inc. has basically purchased an investment in John Inc. So debit the investment in John. And we calculated the amount of the investment to be 600,000. So debit the investment in John, 600,000. Papa paid cash, $150,000. And Papa issued common shares worth 450,000. Right, so notice a big difference here compared to 6.1. In 6.1, where there had been a purchase of net assets, the acquirer company had actually recorded all of the assets and all of the liabilities of the acquiree on its own books. In 6.7, that's not the case. You just have a single line, debit investment in John. Yeah. Now, Papa also incurred $30,000 in legal fees and $25,000 for stock issuance costs. For the legal fees, you want to expense. The stock issuance costs, remember, stock issuance costs are capitalized, which means you need to debit the common shares for the $25,000, and these are paid in cash, so credit cash, 30 plus 25, 55,000. These journal entries, our friend Papa Inc. will have recorded following the acquisition. All right. After the acquisition, then, what's the balance sheet looking like? Papa had cash of $400,000 on its books. That cash has gone down by 150,000 and 25,000. Sorry, 55,000. So 150 and 55 taken out leaves us with $195,000 of cash for Papa Inc. Accounts receivable. Papa Inc. had $150,000 of accounts receivable. Papa Inc. will still have $150,000 of accounts receivable. Similarly, Papa Inc. will still have inventory, 240,000, land 150,000, PP&E 910,000, Goodwill 150,000. What about John Inc.? So what's the journal entry in the books of John? What's the journal entry in the books of John Inc.? Can somebody help me out here? What journal entries will you record on the books of John? So here's the question. When Papa bought 75% of the common shares of John, who did Papa pay the $150,000 cash? Who did Papa issue $90,000 of its own common shares to? Who did Papa Inc. buy the shares from? Leafy shares is John's shareholders. And she's right, or he's right. What do the others think? Who do you buy shares from? It's from shareholders, right? So there is actually no journal entry in the books of John. The transaction was made with the shareholders of John, not with John Inc. So as far as John Inc. is concerned, John Inc. actually is not affected. John Inc. has $25,000 of cash on its books. It's got all the other wonderful assets on its books. It's business as usual as far as John Inc. is concerned. All right. What about the liabilities? Well, the liabilities are unchanged as far as Papa is concerned. Papa's common shares were 300,000, but they've gone up now with $450,000 for the issuance of the additional common shares, less the $25,000 for the capitalization of the stock issuance costs. So John's common shares will be 725,000. Retained earnings for John was 700,000, but it'll go down by $30,000 for the legal fees. So retained earnings for John will now become 670,000. All right. So if we calculate the total for our friend Papa, notice that the balance sheet is not yet in balance, which means we are missing something. And what are we missing? We're missing a line for Papa. It's the investment in John. Thank you. So investment in John Inc. Remember, Papa recorded the journal entry, debit investment in John Inc., 600,000. You bring that investment into play, Papa Inc.'s shareholder, this balance sheet will be perfect. 2,395,000, 2,395,000. Cool. Now, as far as John Inc. is concerned, John Inc.'s total assets are staying at $1 million. Now, as far as John Inc. is concerned, it's got liabilities, $600,000. It's got preferred shares of 100,000. It's got common shares of 100,000, and it's got retained earnings 200,000. So that's John Inc. as a separate company, the balance sheet. All right, so this was a lot of work to get us even started with the consolidated balance sheet. Now, I hope you guys can realize when you're doing it in the exam, you have to be really, really, really quick with all of this, because this just brings you to a point where you can now get started. This is not the consolidated balance sheet, by the way. If I were to show you this, so, if anybody thought consolidation was basically, let's just add up the parent and the subsidiaries amounts, now, some of you might be thinking, hey, Harjinder, isn't that balance sheet balanced? Total of assets, 3,395,000, total of liabilities and equity, 3,395,000. Isn't that my consolidated balance sheet? And I kid you not, a lot of people actually think that at a course that is called Advanced Financial Accounting, after the fact that you've made your way this far, having learned about leases and pension accounting and all the wonderfully complicated stuff out there, if consolidation was just this, can I add the parents' numbers to the subsidiaries' numbers? Well, I don't mean any disrespect, but I think a grade 3 person can do this math, right? That's not what consolidation is about. So, I see this happen on exams. So please promise me that you will not fall for that trap. There's more to consolidate. All right. So what does consolidation require? First of all, we need to get rid of the investment in the subsidiary. So I need to get rid of the investment in the subsidiary. So I need to get rid of the investment. The investment in John Inc. needs to go away. As the investment in John Inc. goes away, I also need to get rid of the entire shareholders' equity of the subsidiary and its existing goodwill. So from the subsidiary, I need to take away its existing goodwill, and I need to remove the entire shareholders' equity. So preferred shares must go, common shares must go, retained earnings must go. They must all go, disappear. So essentially what you're left with here, if you notice, as far as common shares is concerned, you'll be left with just the parent company's common shares. Retained earnings will just be the retained earnings of the parent company. Okay. Now, if you take a look at that consolidated column, the balance sheet is no longer balanced, right? Already out of balance. There's more to be done. What more? You need to include the goodwill on acquisition. So another adjustment will be goodwill on acquisition, $390,000. You need to bring that into the picture. So goodwill will now be 150,000 goodwill that the parent already had, plus 390,000 goodwill on acquisition of John. Added together, you're now looking at 540,000. Likewise, you need to bring non-controlling interest. Now, non-controlling interest is reported as part of shareholders' equity. So you're going to include NCI, total non-controlling interest, $300,000. Okay, so now you have NCI $300,000. The totals are still not there. So there's more adjustments. So what? You need to include the fair value differences. All right. So accounts receivable, we had a 5,000 positive fair value difference. Inventory, we had a 20,000 negative fair value difference. Land, we had 110,000 positive fair value difference. PP&E, we had 65,000 positive fair value difference, so on. Now, the way I want you to remember this is if you have a positive fair value difference, that's a debit. A negative fair value difference is a credit. Okay, remember I said these signs mean something. So here, a positive fair value difference is a debit. So I need to make an adjustment, a 5,000 debit adjustment to accounts receivable. What do I do? If I must debit accounts receivable by $5,000, what does that do to the balance? Does it go up? Does it go down? Goes up. Absolutely. So for the accounts receivable, I will add $5,000. For the inventory, I have a 20,000 credit adjustment. So what do I do as far as the inventory is concerned? If I'm crediting it, the inventory must go which way? Down. All right. Fantastic. So you go through those guys, you make your adjustments. Now notice there's a patent, $50,000, but there's no patent in here. The patent was unrecorded. So when making the consolidated balance sheet, you will need to add a line for the patent. There was no patent at all as far as the parent company or the subsidiary company was concerned, but we identified a $50,000 value for the patent. So guess what? On the consolidated balance sheet, that patent needs to be reported. Liabilities, I have a 25,000 credit adjustment. So what happens to liabilities when we credit them? They go up. That is something that people often don't remember. So just keep in mind, liabilities are already credits. If you credit a liability, they'll actually go up. So after these adjustments are done, now that you look at the balance sheet, the consolidated balance sheet, after these adjustments, what you see is the correct consolidated balance sheet. Notice here, total of assets is equal to total of liabilities and equity. But what are a few things to remember here? Few things to remember. There will never be an amount for the investment account because it should not. On the consolidated balance sheet, the investment in the subsidiary account should not show up. The subsidiary's shareholders' equity is wiped out. It should not show up on the consolidated balance sheet. If the parent company owns fewer than 100% of the common shares of the sub, you should include non-controlling interest. And of course, the balance sheet will be in balance only if you have included the other remaining adjustments, such as the goodwill on acquisition and the fair value differences. If the subsidiary had any existing goodwill on its books, it needs to be gotten rid of. Right there. And total goodwill is just the parent company. Right? Now, you won't have to do this part for an exam or anything, but this is an important little exposition of how these numbers are interlinked. Okay, you should be able to kind of get it clear in your mind. How do these numbers work? Because these numbers are all interrelated, right? Goodwill is an outcome of basically the value of the entire enterprise. And if the value of the entire enterprise includes a certain amount allocated to non-controlling interest, well, as the value for non-controlling interest changes, the amount of goodwill has to change in tandem with it. Okay? All right, I'm mindful of the time, and I'm also mindful that we have to do part B of the Papa and John question. We had done part A. We didn't do part B. So what I would like you folks to do is take a working break. Okay, I'm going to give you folks a bit of a working break. I'm going to give you folks 15 minutes. So don't take the entire 15 minutes as a break. Take a short break. And then when you come back, I want you to work on calculating NCI and goodwill under the INA method for this particular company. So the way to do it, you don't have editing rights on this particular file. easiest way to do it is if you click on the file, right? If you click on file and click make a copy, okay? If you make a copy, it'll open. So if I click make a copy here, it will ask me where I want to save it. You can, kind of indicate whichever sort of folder on drive you want to do that. After you open that file, the copy of the file, you will actually be able to type in and do the calculation. So I want you folks to, in the working break, I want you folks to do the calculation for the identifiable net assets method. And then when we get back together at 7:30, we'll get back together. We will compare if we were on the right track. Okay? Can we do that? Do I have your promise? Yes? All right, fantastic. So I'm going to pause the recording and I'll be gone for a little bit. After that, I'll come back, but I'll be on mute. Okay? So you can still post in questions and I will, as I come back, I'll respond to them. Okay, so now that we have resumed recording, I just want to point out that the difference between what we did in what we did last class for the Papa and John question compared to what would be needed under the identifiable net assets method is that we have to calculate non-controlling interest. And the non-controlling interest is calculated under identifiable net assets. And under INA, non-controlling interests who own 25% of John Inc., they get 25% of the book value, the net book value of John, which we had 225,000, and 25% of fair value differences, which was 185,000. So 25% of this 225 plus 25% of 185,000 gave us 102,500 for non-controlling interest. Papa, the acquirer, paid $600,000 for 75% of John. So that adds up to $702,500 to be the implied value of John. Out of the 702,500, considering that net book value is 225,000, we get acquisition differential of 477,500. Of that amount, 185,000 is explained by way of fair value differences. Difference is goodwill on acquisition, 292,500. To compare the numbers under fair value enterprise, goodwill was $390,000. So the goodwill number here is different. Also different would be the total non-controlling interest. Under fair value enterprise, NCI common was allocated $200,000. $100,000 was allocated to the NCI preferred, getting a total amount of $300,000. Under identifiable net assets, NCI common is 102,500. And so total NCI therefore will be 202,500. Now we had prepared a consolidated balance sheet, right? We had prepared a consolidated balance sheet for Papa Inc. Papa Inc. is the name of the parent company. And the way we had done that, if you just to rejig your memories here, is that we took the parent, the Papa Inc.'s balance sheet, and the subsidiary John Inc.'s balance sheets. We said we add the two together, subject to certain adjustments. And those adjustments basically relate to a couple of things. You need to eliminate, i.e., get rid of the investment in the subsidiary account, as well as the subsidiary's entire shareholders' equity and any existing goodwill. So we managed to do that by getting rid of the investment in John, the existing goodwill for John Inc., and John's shareholders' equity in its entirety. That was the first adjustment, the elimination. Then we said include goodwill on acquisition, non-controlling interest, and the fair value difference. And when you're doing fair value differences, when you're including them, keep in mind that these positives and negatives essentially stand for debits and credits. So a positive fair value difference is a debit adjustment. Negative fair value difference is a credit adjustment. So we basically went through the entire thing. We included the goodwill on acquisition, the NCI, and we included the fair value differences. So accounts receivable had a debit fair value difference. So we debited the accounts receivable, resulting in adding. Inventory had a credit adjustment. Credit adjustment to an asset will reduce the asset. And then liabilities, credit adjustment will increase the liability. So we remember to do that. Now, under INA, all of that is going to be still the same. The only numbers that change is instead of the $390,000 there was for goodwill, under identifiable net assets, your goodwill number is going to be 292,500, and NCI is going to be 202,500. So because of these two changes, what really changes on the balance sheet, the consolidated balance sheet, is the amounts reported for goodwill and NCI and the resulting effect on the totals of the balance sheet. Everything else is identical. Right, so the entire consolidated balance sheet preparation procedure is not changed. The only thing that changes is the dollar amounts for goodwill and non-controlling interest.